Now in this chart, you can see the US unemployment rate overlaid on the prime rate and the S&P 500 chart. This line here is the prime rate, this line here is the S&P 500, and here you can see the unemployment rate. So from 4, 6, 8 and 10% as an all-time high, reached only in the very early 80s, and in 2009 you can see a huge surge here in unemployment. What is interesting to note is when there are large increases in the prime rate, as you can see here, here, and here, who feels the repercussions of that? Yes, investors, with the stock market moving sideways and a sideways essential consolidation here, but the people, the employees feel it with surges of unemployment to an incredible high here. So rather than increasing the prices of their products, the way that business always has and probably always will reduce costs is to reduce people. Now, as you can see here, the interest rates start coming down, the stock market and business earnings start to improve, the economic environment starts to improve, and therefore unemployment starts to reduce. And again, prime rate is down or maintained as stable, and then in the US we see unprecedented lows in the unemployment rate through to 2000. And in 2000, 2003, 2004, you saw an increase, a moderate increase in unemployment as the stock market crashed and people and companies shed jobs. The prime rate came down, was maintained, increased a little bit and then maintained as stable. But because of the credit crisis, businesses need the credit to survive. Modern businesses leverage their company to the maximum. But when there is no more trust and you can no longer leverage your company to maintain maximum profit with minimum outlay, then a huge crisis happens. And you can see here a surge from 5% to 10% in a record time period. And this is why you see over the news reports on unemployment, the prime rates being absolutely important news and fundamental news, and we'll learn how to trade the news in later chapters. However, here we see how they are interrelated and how they depend and interact with each other. There are, of course, many other monetary measures which can be used, and economists love to explain them all in excruciating detail. But we are not looking to learn every detail of economics, but to be able to relate basic principles of market dynamics to the stock market.